Understanding open-ended investment companies, OEICs. Open-ended investment companies, OEICs, have become a significant aspect of the investment landscape in the United Kingdom. Understanding their structure, functionality, and how they compare to other investment funds is essential for both novice and experienced investors. This article delves deeper into what OEICs are, their benefits and drawbacks, as well as how they function in relation to other investment vehicles. What is an open-ended investment company, OEIC? An OEIC is an investment fund structured as a limited company, primarily designed to pool money from multiple investors for investment in equities, bonds, and various securities. Unlike other funds that trade on the stock market, OEIC shares do not have a market listing. Instead, they are bought and sold directly from the fund itself. Key features of OEICs. Open-ended nature. The term open-ended refers to the fund's ability to issue new shares in response to investor demand, as well as canceling shares when investors redeem their stakes. This characteristic allows the fund size to adjust dynamically based on market conditions and investor sentiment. Pricing structure. OEIC shares are priced once daily, with their value determined by the net asset value, NAV, of the underlying assets. This pricing mechanism provides a transparent view of the fund's value, unlike those trading in markets where prices can fluctuate frequently. Regulatory framework. OEICs operate under the oversight of the Financial Conduct Authority, FCA, which provides a level of security for investors, guaranteeing access to services such as the Financial Ombudsman for dispute resolution. Investment strategies and risk diversification. OEICs can adopt various investment strategies, catering to different investor preferences, including income and growth. Some OEICs focus on generating income through dividends, while others aim for capital growth. Market capitalization. Investors can choose funds that specialize in small cap, mid cap, or large cap stocks, allowing for tailor-made strategies based on risk tolerance and financial goals. The diversification inherent in OEICs helps mitigate risk by spreading investments across multiple asset classes, which can reduce the impact of poor performance from any single investment. Costs and charges associated with OEICs. While OEICs offer numerous advantages, potential investors should be aware of the various charges involved. Initial sales charge. Investors often face an initial charge ranging from 0% to 5% when purchasing new shares, impacting the amount of capital that goes directly into the fund. Annual management charge, AMC. The AMC typically falls between 1% and 1.5% of the value of your investment, compensating fund managers for managing the portfolio. Indices and passively managed funds typically have lower fees. Total expense ratio, TR/ongoing charges figure, OCF. These figures represent the total costs of maintaining the fund, which can help investors compare the costs of different OEICs. Exit charges. Some funds might impose a fee when selling shares, though many OEICs do not have exit fees. Tax implications. It's essential to consider that OEICs do not offer tax advantages. Interest and dividends received become taxable income, and selling shares can trigger capital gains tax, subject to current allowances. However, OEICs can be held within tax-efficient structures like individual savings accounts, ISAs, or UK pension plans. Pros and cons of investing in OEICs. Advantages. Professional management. OEICs offer the expertise of professionally managed portfolios, reducing the need for individual investors to have extensive financial knowledge. Liquidity. OEIC shares can be bought or sold daily, providing investors with flexibility in managing their investments. Diversity. With their varied asset allocations, OEICs mitigate risks associated with specific investments. Drawbacks. Fees. The presence of high annual fees and sales charges can erode investment returns over time. Tax liability. The tax implications from investments may diminish overall returns, especially for higher-rate taxpayers. Investment horizon, OEICs are generally suited for medium to long-term investment periods, often recommended for a minimum of 5 years. OEICs versus unit trusts. In the UK, OEICs and unit trusts are two prominent types of investment funds. The primary difference lies in their pricing mechanisms. Unit trusts, these funds typically have bid and offer prices for units, leading to potential discrepancies in pricing for buying and selling. OEICs, they feature a single price based on the NAV, generally making them more straightforward and often resulting in lower fees. Many fund companies have been converting unit trusts to OEICs due to these advantages. Real-world example of OEICs. OEICs can be likened to mutual funds in the United States. A noteworthy example is Fidelity International, a division of Fidelity Investments, which offers various OEICs. In 2018, Fidelity introduced variable management fees across its line of UK-domiciled OEICs, ultimately reducing their base management fees by 10%. This reflects ongoing trends within the investment industry aimed at enhancing investor value through more competitive fee structures. Conclusion. OEICs represent a flexible, professionally managed investment vehicle that can cater to a wide range of investors in the UK. While they offer benefits such as diversification, liquidity, and professional management, potential investors must weigh these advantages against the fee structure and tax implications associated with OEICs. Ultimately, understanding these factors is crucial for making informed investment decisions in today's financial landscape.